going on, guys? Welcome back to the channel. My name is Mark and this is Entrepreneurial Finance. In today's video, we're going to be talking about why your portfolio needs to be positioned defensively right now. Now, before we even get started, I don't want anybody to think that this is, a perma-bear channel. I only think the stock market needs to go down. I'm definitely a long-term investor and I definitely appreciate when the stock market goes up, okay? I'm seeing some things in the market right now that make me a little bit concerned, and I want to talk to you guys about them today and kind of address it and outline them in some graphs, as well as just my general opinion on the overall market right now. Obviously, there's a lot going on worldwide, and I'm going to do my best to give a synopsis as to what I think of the stock market right now and why I think your portfolio needs to be positioned defensively for the long term right now. Okay, so without further ado, let's go ahead and get into it. Okay, so the first reason is basically because stocks or the markets right now are at all-time highs. Now, don't get me wrong, the market trades at all-time highs frequently and has been for multiple years, and has for multiple years in the past as well. But specifically, there's a few indicators which I want to show you guys right now, which kind of indicate that valuations are absolutely insane. So the first one is the market cap to GDP ratio, and market cap to GDP is a long-term valuation indicator for stocks. It has become popular in recent years thanks to Warren Buffett. Back in 2001, he remarked in Fortune magazine interview that it is probably the best single measure of where valuations stand at any given moment. So the Wilshire 5000 index is widely accepted as the definitive benchmark for the US equity market and is intended to measure the total market capitalization of most publicly traded companies headquartered in the US. So you can see here in late January of 2020, we almost hit 1.6% market cap to GDP. And if you just look at where that was in comparison to the tech bubble back in the early 2000s, we've already surpassed that valuation. So this level of euphoria in the market is a little unparalleled, and it's something that gets me a little bit concerned. So the second measure that I want to talk about is the corporate equities to GDP ratio. And this was the original Warren Buffett indicator. So the original measure for market cap is the market value of equities outstanding. Now, the one disadvantage of this one is it's merely being published quarterly, therefore it's always lagging a bit behind. Now, on the upside, it has data going all the way back to the 1940s, thereby providing more historical perspective. So including this data leads to a lower mean average. But again, you can see we've already surpassed the valuation which we were at in the early 2000s during the tech bubble, okay? So again, the level of euphoria that we're seeing in the market is a little bit scary. Retail participation in the market is pretty much at an all-time high, basically because everybody is getting checks all across North America, even though they're unemployed. We have the central banks printing printing money and providing these stimulus packages to keep the economy afloat. And basically lots of people are using that to start investing, okay? So you have people maybe like 18, 19, 20 years old throwing their money in the market, really who have no idea what the heck they're doing. And I have a couple examples later on in the video, but I just wanted to throw that in there. So the next one is the Dow to GDP ratio, and in contrast to the Wilshire 5000, the Dow Jones only contains 30 publicly traded companies, and the index is price weighted, so stocks with a higher share price are even given greater weight. For these reasons, it's not as accurate as the Wilshire 5000 for measuring the market capitalization. However, all these ratios look very much the same, but one thing with this one, you can see it isn't as high in relation to previous bubbles that we've seen. So that's why I showed you the market cap to GDP ratio first, as well as the corporate equities to GDP ratio second, because you can definitively see in the first two graphs we're much higher in terms of valuation than we were basically at the previous stock market crashes. Okay, so next one is the S&P 500 to GDP ratio, and in contrast to the Dow Jones, this contains the 500 largest US companies. Just like the Wilshire 5000, it's a capitalization weighted index. It captures approximately 80% of the available total market capitalization. For these reasons, it's a much better measure for market cap than the Dow Jones. However, again, the two charts look very similar, and I think the first two graphs I showed you are a little bit more indicative of where we are in terms of the overall stock market. Okay, so this last graph is directly from the Fed website, and I wanted to show the corporate profits after tax as a percentage of GDP. So generally speaking, as corporate profits grow and are distributed to shareholders, the stock market should rise. As you can see here, corporate profits after tax as a percentage of GDP has actually been declining since 2012, while the stock market has basically shot to all-time highs. Now, I don't want to be naive here. I understand that the stock market is not the economy, but just so that you guys understand, GDP is measured essentially by corporate profits, and the stock market is essentially giving you a value of future corporate profits, okay? So it's a discounting mechanism. As corporate profits are declining as a percentage of GDP, it's usually not probably the right thing to see stock markets shoot to all-time highs. So the second reason I have for you guys is the uncertainty regarding the coronavirus. So the second wave of infections, I think we're starting to see that across the US right now. I live in Canada. We're still pretty much on lockdown in Ontario, although other provinces are starting to open up. But specifically in the US, after a couple weeks of being open, certain states are showing upticks in infections already this week. Part of the uncertainty regarding coronavirus is essentially the protests surrounding Black Lives Matter. And I don't want to say that the protests are wrong, because they're certainly not. They're definitely a just cause, and there does need to be a real world change globally with the way that people of color are being treated. However, scientifically speaking, and I'm no scientist, okay, the more gatherings you have of thousands of people that are extremely close to each other certainly increases the possibility of spreading or contracting COVID-19. Okay, and as we've seen across the US, across the world, really, tons of protests going on worldwide, tons of people are really close to each other, and there's a good chance that the virus is spreading at these protests. Don't get me wrong, I'm all for these protests and the cause. It's a great cause, and there does need to be a change worldwide in terms of abolishing racism. Okay, and just the last part of the coronavirus here, increased infections reduce demand, and this isn't just for one sector, it's generally for all industries. And again, don't get me wrong, there's still companies that are going to perform well in this environment. Take, for example, Amazon or Shopify, for example, which have hit all-time highs during this quarantine, while basically traditional brick-and-mortar stores have gone bankrupt. They've basically taken that market share from them in terms of retail demand. Now, my last reason is, and again, I don't want to get anybody mad here, okay? If you're not a Warren Buffett fan, this video might not be for you. I definitely am a Warren Buffett fan and have studied the way that he invests for a very long time. But he's basically sitting this one out, okay? And what I mean by that is he sold all his airline stocks. A lot of people are calling Warren Buffett a fool for selling the airlines as they've essentially rebounded from their all-time highs, their all-time lows. And retail investors are profiting ridiculously off companies which are seeing massive drawbacks in their stock price. So this includes airlines, this includes cruise lines, Hertz, JCPenney, etc. Okay, so companies like Hertz and JCPenney are announcing bankruptcy, and then they're seeing their stock price absolutely soar. For all of you out there making profits off these companies, give yourself a pat on the back. Great work, because I don't know anybody who would have invested in a company that announced bankruptcy. However, if you made money off that, great for you, okay? One thing, though, is that Warren Buffett is definitely not an idiot. He's been investing in stocks since the 1940s, and he's one of the richest people in the world because of it. I would actually highly urge you to research and read about Warren Buffett techniques over the years, as it will almost certainly make you a better investor in general. His main strategy has been to buy and hold, and his analysis is unparalleled, which leads me to my second point here. I'm going to leave a link in the description to this article that I'm going to reference, okay? And as it was mentioned above in the Fortune magazine, he gave an interview in 2001 about his feel of the current market environment. And as a lot of you might know, that was basically the tech bubble. And as you see, we saw a lot of euphoria with tech stocks going to all-time highs, kind of like we're seeing now. We might be in somewhat of a similar situation, but interest rates are different, the current market conditions are different, and we're going to get into that, okay? So just one second. So the whole reason I was even showing you the market cap to GDP indicator, as you'll see up here, it's from a reading that I was essentially assigned in university. Like I said, in 2001, Warren Buffett was interviewed by Fortune magazine and spoke about the state of the current market, which is something he rarely does. So there were various things that he cited in this article, but his statement at the end is somewhat famous, basically stating that the single best measure of valuation at any given time is the market cap to GDP indicator, As valuations continue to climb and trade over 100% of GDP, the level of euphoria in the market can sometimes create a bubble or at least justification for a correction. Now, don't get me wrong. We all know very well that the economy is not the stock market. I also don't think, or don't want any of you to think, that I'm a perma bear here and I only think the stock market will go down. Market conditions are much different than they were back then. This is something Buffett explores in depth within the article, which I definitely urge you to read. There will be a link in the description. An important thing to cite is that the Fed is currently employing a ZIRP policy. What is ZIRP, you ask? Zero interest rate policy. And actually, just this week, they stated that they don't see interest rates being raised until at least 2022. This is an important factor in, as generally speaking, the lower interest rates are, the cheaper stocks are, okay? As interest rates remain low, it may very well be the justification for the mark to continue rising to all-time highs. However, if you're someone like me and are somewhat worried about the most famous investor of all time selling various parts of his portfolio and market cap to GDP indicating valuations are even higher than they were during the tech bubble of the early 2000s, I'm going to give you 3 ways you can position your portfolio defensively. So the first one is a diversification, and this is basically the oldest trick in the book, okay? And probably the easiest way to remain invested while giving yourself exposure to different sectors within the market. If you've watched some of my previous videos, you'll have heard me talk about the 11 different market sectors and which ones are considered more defensive. In times of market turbulence, the sectors which tend to perform the best are healthcare, utilities, and consumer cyclical, something like grocery stores, you know what I mean? High-risk sectors generally include consumer non-cyclical, technology, and energy. Okay, so if you're a little bit worried maybe about where the market is headed right now, maybe put some of your money in utility stocks with high yielding assets, or with a high dividend yield, and maybe transition your strategy to dividend yield investing. I would always recommend that you diversify your portfolio regardless of current market conditions, but we all know new investors may tend to put their eggs all in one basket and avoid investing in things they know nothing about, such as utilities or telecommunications. Okay, diversification will provide unforeseen benefits and allow for your portfolio to be more balanced. You may even see appreciation in certain sectors which you don't anticipate and will benefit greatly from it. Like I said, that's the oldest trick in the book. The second thing I'm going to mention is to hold cash and don't fully invest. This is a pretty simple strategy, but not always recommended, okay? As most money managers will tell you, timing the market is certainly more important than timing the market. However, if you're extremely panicked and feel market conditions are uncertain, or you don't want to invest at all-time highs, you can always keep a percentage of your portfolio in cash, so that when there is a dip or buying opportunity, you have the capital to take advantage. You can also use this cash to dollar cost average, which normalizes the purchase price of a security as you buy the same stock over a certain period of time with pockets of cash, ultimately with the goal of reducing your average purchase price. Okay, and my last tip here, and this one again, one of the older tricks in the book, nothing crazy here, nothing groundbreaking, but use or utilize blue chip companies, okay? So as Warren Buffett always said, he'd much rather buy a wonderful company at a fair price than a fair company at a wonderful price. Why is that, you ask? A lot of the times, companies which sustain over the long term are much more likely to pay you dividends and increase their dividends and ultimately provide you benefits or capital appreciation which was unforeseen. For instance, if we look at a company like Apple, their big claim to fame was the iPod, and I believe it came out in like 2004. Multiple decades later, or multiple, let's say, we're what, 15 years later, 19 years later, 16 years later from that, they're one of the largest phone producers and sellers worldwide. Would anyone have been able to predict that after they released the iPod? They're a computer company. How did you know they're going to get into phones? So probably not is the answer, but they are a great example of a wonderful company which you could have bought at a fair price in the early 2000s or even in the 2010s, and they pay a good dividend and they're cash ridden. So moral of the story, buy good companies at a fair price and not bad companies at a wonderful price. Okay, so that's all I have for you guys today. If you did get some value out of this video, please consider subscribing, smash the like button, and I'll see you guys in the next video. Peace out.